What's up, my fellow wealth creators? Matty Guys here. Welcome to another training. Today, I want to talk about the difference between cost of insurance and net amount at risk, particularly when we're talking about an IUL, Indexed Universal Life Insurance. For me, this is a two very important things that you need to understand before you move forward with an IUL. All right, I've said this many times. You guys probably know by now, I am not a fan of IUL. It doesn't make sense to me, but that doesn't mean that it doesn't make sense for you. My biggest issue with IULs is that a lot of times people have no idea what they're actually putting their money into. They just hear that you can get upside potential, downside protection in the market, you get all this tax-free income. It sounds great. Okay, that does sound great, but how do these things actually work? And for me, if you can't even if you can't describe the difference or understand the difference between cost of insurance and net amount at risk, you have no business buying an IUL. They are very, very important to understand because they have such a massive impact on what happens to the policy. So what I want to do is share my screen. We're going to go through some actual numbers, and at the end of when we're mapping, just going through everything, I'm going to show you an actual IUL illustration that breaks down the cost of insurance, just so you understand that your cost of insurance actually goes up every single year and exponentially as you get older. It's not really a problem when you're younger, but as you get older, because IUL is built on annual renewable term, it can get very, very expensive. Now, that doesn't necessarily mean that you're going to have to fork up a ton of money to keep the policy in force or that your policy is going to lapse, even though it could, especially if it's not designed properly. But that's where net amount at risk comes in, and being able to understand how to manage that net amount at risk, because that's what you're actually charged on. It's very important to understand that distinction. So if you can keep your net amount at risk as low as possible, while you're taking income, things like that, cost of insurance, not going to be too big of an issue, but it absolutely can be. And if your policy is not set up correctly, if you're not managing it on an annual basis, reviewing your in-force illustration, reviewing the actual numbers within your policy, if your net amount at risk gets too high, that cost of insurance can really get out of control and put you in a pretty precarious financial situation. So just understanding these things so that you can have a better conversation with your agent, because a lot of times agents don't make this distinction. I've even heard agents say that your cost of insurance goes down every single year. That is absolutely not true. Your cost of insurance goes up every single year. Your net amount at risk might go down, assuming that the policy performs as illustrated, which is another big issue that I have with IUL, is how they're illustrated, but that's another conversation, right? It comes down to the net amount at risk. And if your net amount at risk gets too high, that could put the policy in big trouble. All right. So let me go ahead and share my screen and we'll get into it. So like I said, this is really, really important for you to understand the difference between cost of insurance and net amount at risk if you are considering something like an Indexed Universal Life policy, IUL, because these are going to have a major impact on your policy and your ability to take the income that you're expecting to take. It can have a massive impact on the performance of the policy as well. And so I'm not saying not to pursue an IUL, even though I'm not a fan of them. I don't like the rising cost of insurance and that you have to manage that amount at risk. It's just, there's too many things that can go wrong with it. But it doesn't mean it's not right for you, as long as you understand how these things actually work. All right. And also, like when I hear agents say that your cost of insurance in an IUL actually goes down as you get older, that is absolutely ridiculous. It is a half truth. Your cost of insurance goes up every single year because IUL is built on annual renewable term. Your cost of insurance goes up every single year. Now, what they're actually talking about is your net amount at risk might go down, which again, we're going to break this down with numbers and all that stuff here in a second. I'm actually going to show you an illustration, an IUL illustration that breaks down cost of insurance too, so you get an idea of what this is. But it's important to know the difference, because your cost of insurance can get it does get really expensive as you get older. But what I will say, as long as you manage your net amount at risk and keep that as low as possible, it's not that big of an issue, but you need to understand it so that you can make the best decision for you. All right. So this is one of the things that deterred me from doing an IUL. I just don't want to mess with this stuff, but maybe it makes sense for you, whatever. So let's start with cost of insurance. So again, I'm going to try and keep this as simple as possible. Let's use me as an example. I'm 35 years old right now. So my cost of insurance, like if I were to go get a term policy, is going to be very low. It's very, very cheap because I'm 35, I'm healthy, I'm not likely to pass away anytime soon. Most term life policies, I think it's like 1%, maybe less, actually pay out. And the life insurance company knows this, and that's not necessarily a bad thing. It's important to protect your family. Right? You can get 10, 20, 30-year policies, whatever. But my point is, the younger you are, the cheaper this is. It's not really an issue. So my cost of insurance, when you look at an IUL illustration, and I'll show this to you in a second in the illustration, my cost per $1,000 of death benefit might be 11 cents, all right, which is very cheap. So if you did the math on that, so, if I have a $500,000 death benefit, and I'm 35, and per $1,000 is only 11 cents, that's going to be really cheap for that amount of coverage, right? The problem starts to arise, or the potential for issues start to arise as I get older. So let's say, I build this thing up for, 40 years, and let's say at 75, so now I'm 75 years old, and I'm going to start taking income from this thing. My cost of insurance might actually be like $5 or $6 now, for the same $1,000 of death benefit. Now, again, this doesn't necessarily mean that you're going to get this massive bill for your cost of insurance, even though you absolutely could if your policy does not perform and you don't manage your net amount at risk. But that kind of allows me to segue over to what net amount at risk is. This number right here, whatever the cost of insurance is for however old you are in that particular year, it's only applied to the net amount at risk over here. Now, what is net amount at risk? It's very simple to calculate. Death benefit minus cash value equals net amount at risk. So if you ever want to know what your net amount at risk is, just do this math. Pull up your in-force illustration, look at what your death benefit is, look at what your cash value is, subtract it. That's your net amount at risk. So, for example, if I have $1 million in death benefit, let's say my death benefit equals $1 million. My cash value is $950,000, which is the idea of an IUL is the net amount at risk shrinks as the cash value grows. So like, for example, when you stop making premium payments, usually you start with an increasing death benefit. When you stop making premium payments, you switch over to a level death benefit. So your death benefit stays the same. So as the cash value grows, the difference between the death benefit and cash value, which is the net amount at risk, that shrinks. So what you're actually charged every year for your cost of insurance goes down. That is true. But to say that your cost of insurance goes down every single year, that is very misleading, because your cost of insurance goes up every single year exponentially as you get older. That is important to understand, because if your net amount at risk, so in this case it's $50,000 in this example, right? $5 per $1,000 of death benefit. Really, it's $5 per $1,000 of net amount at risk is, I guess, the easier, more simple way to explain it. All right. Then, it's not a very significant cost, especially, if you've built up good amount of cash value, and let's say the market does good that year, your index does good, and, you make 10%, and, that equals a $25,000, $30,000, $50,000 credit, whatever it is, depends on how much cash value you have. Then the cost of insurance is not really a big deal, right? It's easily covered by the credit that you get. The problem is what happens when you have multiple down years throughout your retirement, those 0 years. Where's this cost of insurance coming from? Well, it's coming from the cash value. So again, it doesn't necessarily mean that your policy is guaranteed to lapse as long as it's designed properly, but you need to be managing and monitoring your net amount at risk every single year to make sure you keep that under control. Because my problem with IUL illustrations is that it shows an eternal bull market every single year. That's not going to happen. You are going to have 0 years where you don't get that credit. There's cost of insurance that needs to be paid. You've got a loan balance that's compounding against you. That interest needs to come from somewhere. All right, so all those things can have a massive impact on your policy, guys. So the most important thing is to make sure that you are managing your net amount at risk as best as you can. That's why it's important to always meet with, have an annual meeting with your agent, pull an in-force illustration on your policy, and go through the numbers. What can you do to make sure your net amount at risk is as low as it possibly can be? All right, so that's the difference between cost of insurance. It's basically a net amount at risk. The cost of insurance is used to determine how much you need to pay that year based on whatever the net amount at risk is. And the problem is as you get older, if you deplete the cash value too much, and either due to poor performance, taking out just leveraging it too much, taking out too much income too fast, whatever, if your cash value cannot cover your cost of insurance because your net amount at risk is too high, that's when you're going to get that bill saying, hey, you need to pay X amount in order to keep this policy in force. Do you really want to do that at 75, 80, 85 years old? No. Not to mention, if you do let the policy go, if it does lapse, it could result in a massive tax bill as well, not to mention all the other issues. And here's the thing is, I'm not so worried about properly designed IULs lapsing, really. If they're set up properly, it does significantly reduce the possibility of it lapsing. But the other thing to consider, though, is if you were planning on taking all this income, $100,000 tax-free for the rest of your life starting at 65, but you're 75 now, or 80, and you've depleted the cash value because it didn't perform as illustrated or whatever it is, now you don't have all that income. What are you going to do, right? So these are all things that can happen. Not saying they're guaranteed to happen, but they can, and you need to prepare for that. What's the plan if this thing does not work out the way that you think it's going to, right? And understanding these two concepts right here, these two parts of the policy, is really important for answering questions like that, right? Once you understand these two things, now you can start to make better, more informed financial decisions about whether or not this makes sense for you. So, yeah, hope that makes sense. And I do want to show you really quick. This is an IUL illustration here. I just wanted to show you, like, it's going to be at a different page and probably set up differently across different companies. But most IUL illustrations, I believe, do have this. And it's the guaranteed maximum monthly cost of insurance rates per $1,000. All right. So like I said, starting at 35, yeah, like right here is only 11 cents. Not a big deal. But then if we go over to this column, when I'm 70, wow, I grossly missed that one. It's only $1.50 right there. So still not that bad in this particular case. But it's still a very significant increase in the cost of insurance. And that was really my point, is cost of insurance goes up every single year. Look at when we're 80, 4.5, 81 is when it hits the $5 mark. 85, we're at $8 per $1,000 of insurance when we started at 11 cents. This is how annual renewable term works and how cost of insurance works. So this is going to go up every single year. The important thing to manage, though, is the net amount at risk, because this right here gets applied to the net amount at risk, not your total death benefit, net amount at risk. All right, so that might it might make sense for you to do that as long as you keep that net amount at risk low, but just understand that your cost of insurance goes up every single year. All right, guys. So I hope that was helpful. When you break these things down and just go through it a couple times, it's not that complicated. Cost of insurance goes up every single year. Okay, got it. But that's only applied to net amount at risk. Okay, this is how net amount at risk is calculated. Got it. Okay, that makes sense. Whether or not that is a deal breaker for you is going to depend on your risk appetite, how much control you want over these different things. There's a lot of other moving parts as well that can impact net amount of risk, the performance of the policy. You got participation rates, you've got cap rates, you have additional fees and whatnot. Like all these things you need to take into consideration. But understand, for me, when it comes to IUL, understanding the basics first, the foundation, which is, to me, it's cost of insurance versus net amount at risk. You have to understand at least that. Okay. And like I said, it's not necessarily, it doesn't have to be a deal breaker. You just have to know how these things work so you know what you're putting your money into. That's the biggest thing for me, guys. So I hope it was helpful. If you have any questions, drop some comments down below. I'd love to hear your feedback as well. Make sure you check out all the links in the description for lots of really good training on infinite banking, life insurance, all that good stuff. But either way, I hope you guys are crushing it, and I will talk to you in the next one. To your success, Matty Ice is out.